welcome to Auto News Talk. You walk into a dealership and instantly your guard is up.
Oh, absolutely.
You're scanning the room, bracing for friction, just wondering if you're going to spend like the next 5 hours locked in a tiny glass office haggling over paperwork.
Yeah, we've all been there. It's not fun.
No, it's not. But behind the scenes, the entire ecosystem that actually creates that experience is undergoing this massive, rapid mutation. Because profit margins on the metal itself are razor thin. The vehicles are evolving into these complex rolling computers. And honestly, consumer patience has basically evaporated. The industry is desperately trying to rewrite the rules of survival. So let's unpack this.
It really is a remarkable terrain to observe. Because when you look at how the entire infrastructure of selling a car is adapting, I mean, survival requires this really brutal balancing act right now.
Right.
Dealerships are caught in this tension, right, between deploying highly aggressive automated technology to cut costs and simultaneously trying to preserve a, highly authentic, emotional human connection.
Because if you lean too far one way.
Exactly. If an operation leans too heavily on automation, it feels cold, it's untrustworthy. But if it leans too heavily on legacy human processes, it just bleeds money.
Yeah, so I want to build a complete mental map of this new ecosystem for you. We're going to trace the exact life cycle of a modern car sale.
From start to finish.
Exactly. We'll start out in the digital ether, where a buyer actually decides to trust a dealer. Then we'll move into the high-stakes choke point of the finance desk.
The dreaded finance desk.
Right. And after that, we'll walk out back to the physical realities of the service bay. And finally, we'll stand on the showroom floor where the vehicles themselves are having kind of a bizarre identity crisis.
It's a lot to cover.
It is. So let's start at the front lines. Engineering trust. Because trust used to be like a firm handshake and a cup of bad coffee in the showroom, right?
Yeah, the classic approach.
But now that transaction happens entirely on a smartphone screen before the buyer ever even leaves their couch.
Well, the physical showroom has essentially been demoted.
Wow. Demoted.
Yeah, I mean, it's no longer the place where you win the customer. It's really just the place where they come to pick up the keys.
Right.
And there's this fascinating strategic guide I was looking at from Glow 3D that maps out exactly how dealerships are attempting to engineer that pre-arrival trust.
What's their take?
The central argument there is that the car buying journey is irrevocably digital first now. And raw, unscripted customer video testimonials are basically the only viable substitute for that old school physical handshake.
Okay, but we're not talking about like a polished commercial, right?
Yeah.
With drone shots and dramatic lighting. Okay. Because as a buyer, I'm completely immune to slick corporate marketing. It just washes over me. I assume they're lying to me.
Oh, exactly. And that's the core psychological shift the Glow 3D report highlights. They point out that 76% of consumers view content from real, everyday people as significantly more credible than anything generated by a brand.
76%.
Yeah. They want to see a slightly shaky smartphone video of a visibly relieved family standing next to a minivan.
Right. Something authentic.
And the data backs this up with a pretty staggering metric. They found that 88% of customers trust those video testimonials just as much as a personal recommendation from a close friend or family member.
Wait, really? 88%?
Yep.
That is a wild psychological hack. Like, a stranger on a screen carries the same weight as your best friend.
It's crazy, but it works.
But how do you actually capture that without it feeling totally forced? Because, if a dealer hands me a script, I'm going to sound like a hostage reading demands.
Yeah, you would.
Yeah.
And the unscripted nature is mandatory. The guidance from Glow 3D lays out very strict parameters for this. The sweet spot is keeping the video anywhere from 30 seconds to a maximum of 2 or 3 minutes.
That's right. Keep it short.
Keep it short. And the prompt shouldn't just be some generic, hey, tell everyone how great we are. It needs to be surgical. It has to focus on a specific problem the dealership solved.
Like what?
Like, did they untangle a nightmare trade-in scenario? Or did they respect your time and get you out the door fast?
You got to incentivize that, though. I mean, no one just volunteers to film a video after signing paperwork for 2 hours.
You do. And modest incentives, like a discount on a future oil change or a small gift, are viewed as perfectly acceptable, provided the words remain the customer's own.
Okay, that makes sense.
And once they capture it, the dealership just blasts these micro stories across vehicle detail pages, social media, email blasts. The whole mechanism relies on raw social proof to short-circuit the buyer's natural skepticism.
It's brilliant marketing. But here's my issue with it. Does this actually move metal? Because it's one thing to say, hey, 88% of people trust this video. It's an entirely different thing to prove that the video resulted in 5 extra SUVs driving off the lot.
And that is the glaring limitation of that Glow 3D framework.
Yeah.
Yeah, I mean, it outlines a compelling psychological theory, but what it doesn't answer is the hard ROI question. It completely lacks hard return on investment data. There are no specific case studies or concrete performance metrics showing a direct lift in sales volume.
So it's all feelings, no math.
Right. It tells us how to build a feeling of trust, but it can't quantify the conversion of that feeling into revenue.
And frankly, trust is incredibly fragile. You know, I always think of it like looking up a restaurant in a new city.
Okay, like this.
Those Glow 3D video testimonials, those are the glowing 5-star Yelp reviews. They do the heavy lifting of getting you in the door.
Right.
But if you sit down and wait 2 hours for your food, you're never going back, no matter how good the reviews were online.
Oh, for sure.
In a dealership, the slow service is the finance desk. Trust gets a buyer in the door, but operational friction at the desk will just chase them right back out.
That restaurant analogy perfectly captures the bottleneck.
Mm-hmm.
You can have the best marketing in the world, but if the underwriting process is agonizing, you destroy the customer experience.
Oh.
There's an incredible operational breakdown I listened to featuring an executive from the lending platform Upstart alongside a dealership manager. And they dissect exactly why fast, credible financing decisions are the ultimate competitive advantage, especially when you're trying to catch first-time buyers.
Oh, man, first-time buyers are always the hardest to finance. They don't have a mortgage. They haven't paid off 3 previous car loans.
Exactly.
If you just look at a traditional 3-digit credit score, they look like ghosts.
Or worse, they look like high risks. And the Upstart breakdown argues that traditional credit scoring is fundamentally backward-looking. It heavily penalizes people without long histories. So lenders relying solely on those legacy scores are just blindly turning away highly qualified buyers.
So what does Upstart do differently?
Their mechanism bypasses that by evaluating hundreds of alternative variables. They look at roughly 280 specific data points.
Wait, 280? What are they even looking at?
They're analyzing the actual structural integrity of the buyer's life. They look at nuanced payment-to-income ratios, the granular stability of their specific industry, job tenure, complex loan-to-value structures. It creates a predictive model where a strong, stable income profile can effectively neutralize a marginal traditional credit score.
Okay, so they're underwriting the human being, not just the math. But it isn't just about getting the yes, right? That Upstart piece makes a massive point about speed.
Speed is the entire ballgame. They detail scenarios where a 10-second automated lending decision entirely flips the dynamic of the sale.
10 seconds.
Yeah, it prevents the customer from walking out to, think about it, which we all know is just code for shopping at a competitor.
Right.
And the financial penalty for moving slowly is devastating. The interview highlights that a single extra day of delay on a used car adds roughly $1,000 in aging expense per unit.
Wait, I want to pause on that because that number is staggering. $1,000 just for a car sitting there for an extra day.
It adds up incredibly fast.
But it makes sense when you look at the mechanics of a dealership. The dealer doesn't own that car outright. They are paying floor plan interest to a bank every single day it sits on the asphalt.
Exactly.
The metal is depreciating. It's taking up physical real estate. You multiply that $1,000 across a massive inventory, and slow approvals are just a silent margin killer.
It absolutely hemorrhages cash.
Yeah.
So to stop the bleeding, the Upstart strategy proposes completely dismantling the traditional workflow.
Okay, how?
Well, instead of the old single offer, single vehicle submission, which creates this agonizing, drawn-out negotiation,
Right.
they advocate using soft credit pulls immediately. You run the complex algorithm and instantly surface multiple financing offers across several different vehicles in one shot.
Oh, wow. That changes the entire psychology of the desk.
It really does.
You shift the conversation away from the anxiety of, like, will the bank reject me?
Right.
And turn it into a collaborative, hey, based on your profile, which of these 3 cars fits your monthly budget best? It completely removes the adversarial tension.
It's a massive upgrade to the customer experience. However, there is a harsh operational reality that the Upstart executives themselves admit.
What's the catch?
Technology is completely incapable of fixing a fundamentally broken physical process.
Yeah.
If a dealership's baseline staff training is poor, or their internal communication is chaotic, dropping a hyper-fast AI tool into the middle of that mess just creates faster chaos.
Garbage in, garbage out.
Exactly. And furthermore, this entire ecosystem relies on external infrastructure. If vendor networks or lender systems experience downtime during peak holiday buying rushes, that 10-second AI algorithm is utterly paralyzed. You are back to pen and paper.
Right. You cannot out-tech a terrible foundation.
Yeah.
So we've built the digital trust, and we've navigated the high-wire act of the finance desk. Let's physically walk out of the showroom and look at the larger operational reality of running these massive retail footprints.
It's a tough environment out there.
Because the pressure on the dealership model right now is intense.
It requires a level of ruthless agility that legacy dealers are just not used to. There's an incredibly candid interview with the managing director of the Peter Cooper Motor Group that illustrates what survival actually looks like on the ground.
Okay, what are they doing?
Well, they managed to pull off a record-breaking Q1 sales period in the UK, despite broader economic headwinds that were suffocating their competitors.
Wait, how do you achieve record growth in a shrinking market? What is the lever they pulled?
They completely dismantled their allegiance to legacy brand structures.
Really?
Yeah, they recognized that relying solely on their historical stalwarts brands like Volkswagen and Kia just wasn't enough. Demand for those core vehicles held up, but they aggressively expanded their physical footprint to absorb brand new, highly unproven Chinese entrants. Specifically, they brought in XPeng, Omoda, and JAC.
That is a massive operational gamble. I mean, you have to train technicians on completely alien engineering, buy new specialized tools, dedicate highly expensive real estate to brands that most consumers can't even pronounce yet.
The capital risk is huge, yeah. But the velocity of the payoff is what makes it necessary. According to the interview, Omoda and JAC reached roughly 50,000 UK sales in their initial launch window.
Whoa.
To provide some historical context, the report notes that it took a legacy giant like Kia, a massive fraction of its corporate history, about 14 years, to achieve that exact same volume milestone.
14 years versus one. The acceleration of market adoption is terrifying if you're a legacy automaker.
Yeah.
But agility isn't just about adding new things, right? It's about having the stomach to kill off the things that don't work anymore.
And they proved they have that stomach. The Peter Cooper Group made the deeply painful decision to permanently shut down their Bognor paint and body center.
Oh, wow.
Yeah, it was a deeply established legacy facility that had been operating for 40 years.
You don't just board up a 40-year-old facility lightly. What was the mechanism forcing their hand?
It was an inescapable margin squeeze. The director cited astronomical hikes in commercial rent, which was completely compounded by insurance companies refusing to increase their payout rates for labor.
Ah, the insurers.
Right. The insurers dictate what they'll pay for a collision repair. And if those rates remain stagnant while the cost of human technicians, electricity, and rent skyrockets, the physical facility literally cannot mathematically sustain itself.
It's a perfect storm of fixed costs crushing a business model.
Exactly. So to survive that loss of revenue, they immediately pivoted. They expanded into independent, non-franchise after-sales service networks like Bosch to capture older vehicles, and they started installing EV charging infrastructure.
It's constant, exhausting reinvention.
It really is. And on top of the physical challenges, the interview sheds light on a suffocating regulatory paradox they're fighting.
What kind of paradox?
It involves financial regulators in the UK, the FCA launching massive redress inquiries. They're demanding extreme historical transparency regarding legacy motor finance commission structures. They want data from transactions that happened back in 2007 in a completely different era of the industry. The problem is, sweeping European data privacy laws, specifically GDPR, mandated that companies actively delete consumer data after a certain period to protect privacy.
Oh man, I see the trap. The privacy laws forced the dealerships to destroy the archives years ago, and now the financial regulators are threatening them for not producing the archives.
Yeah.
It's literally impossible to comply with both.
Exactly. It highlights the invisible administrative friction dragging down operations. But I want to circle back to the physical bottleneck we touched on. Closing that legacy body shop because skilled human labor and physical overhead became too expensive.
Right.
Because when human labor prices itself out of the market, the industry responds with automation. And we're seeing that unfold in the service lanes right now.
You're talking about the AI inspection systems.
Yeah.
I was reading UVI's own data claims on this, and it feels like science fiction. They're building these massive physical drive-through arrays for dealership service lanes, It looks like an architectural scanner or like an MRI machine for a car.
The mechanics of it are deeply impressive. As a vehicle simply drives through the physical archway, the system deploys multiple high-resolution cameras and sensors. It uses deep learning algorithms to map the entire undercarriage, analyze tire tread depth, scan every exterior panel.
Wow.
It's trained on millions of images of quote-unquote perfect vehicle components, so it instantly recognizes anomalies. A microscopic fluid leak, a sidewall bubble on a tire, a subtle misalignment in the suspension.
And the scale of deployment is massive. Like the reports note, this isn't just a pilot program for a few luxury dealers anymore.
No, not at all.
Major global automakers like Toyota and GM are integrating it. Dealership networks are putting them in the drive lanes. Even Amazon is using these arrays at their logistics hubs to scan delivery vans.
The sheer volume of data being processed is difficult to comprehend. UVI systems are actively scanning over 3.5 million vehicles a month.
3.5
Oh,
million.
yeah. And the speed is the real disruptive force. The system generates a completely standardized, granular condition report in under a minute.
Wait, under a minute. Let's think about the human mechanics of that. For a technician to do that same job, they have to physically drive the car into the bay,
Yep.
position it on a hydraulic lift, raise it up, walk underneath it with a flashlight, manually gauge all 4 tires, lower it back down, and then type out a report. That takes 20 to 30 minutes of highly expensive labor.
Easily. And by compressing that into under 60 seconds, it effectively removes the labor constraint issue. It also standardizes the data. A car scanned at a manufacturing plant generates the exact same baseline profile as a car scanned 2 years later at a used car lot.
Here's what I'm wondering, though. If AI can scan a car in under a minute, why are legacy physical operations like a 40-year-old body shop being forced to shut down? Is technology actually saving money, or is it just shifting where the money is spent?
Wow.
Because UVI claims a 96% detection accuracy rate, comparing it to a dismal 24% accuracy rate for manual human inspections. But as the source material openly admits, that 96% figure is strictly an unverified claim generated by the company itself.
You're right to be skeptical. There is no independent third-party validation for that accuracy gap. And we have to remember the physical limitation of the technology. AI is strictly diagnostic. It requires a massive upfront capital expenditure to build the physical array. And yes, it lowers the operational cost of finding the broken part. But AI cannot hold a wrench.
Exactly.
It diagnoses the damaged suspension in 60 seconds, but the dealership still has to employ the highly skilled, expensive human mechanic to actually fix it. It doesn't replace the physical labor of repair, it just hyper-accelerates the diagnosis.
Which brings us to the final stop on our map. The showroom floor itself. We've optimized the trust, the financing, and the service lane. But ultimately, you have to sell the metal.
You do.
And the legacy automakers are facing a massive identity crisis when trying to sell distinct physical products under the same dealership roof. Here's where it gets really interesting.
It's a fascinating problem. This is where engineering meets retail psychology. A strategic overview of Stellantis reveals a really interesting experiment in brand separation.
What are they doing?
They're launching the new Ram Charger SUV and the Jeep Grand Wagoneer. Because Ram and Jeep share the exact same physical dealership networks, Stellantis is forced to deliberately engineer totally distinct physical and driving personas for these two vehicles to prevent cross-shopping confusion.
See, I'm struggling to understand how this works in physical reality. You're building 2 massive, highly expensive 3-row SUVs. You're parking them 50 feet apart in the exact same building. How do you convince a buyer that they're completely different animals?
You alter the fundamental architecture and the sensory experience of driving them. The strategy dictates that the Grand Wagoneer acts as the pinnacle luxury flagship.
Go.
To achieve that, it gets the turbocharged inline-6 engine and, crucially, an extended-range electric vehicle, or ERV, option.
So the mechanism of an ERV is that it uses electric motors to drive the wheels, offering that incredibly smooth, silent, high-tech acceleration, while a gas engine acts as a generator. It feels very refined.
Highly refined and priced accordingly. We know the luxury baseline cost. The Wagoneer starts at $66,790.
Right.
The Ram Charger, conversely, gets a much more aggressive, truck-like architecture. It leans into raw power with a V8-led strategy, and there's even an SRT high-performance trim.
Totally different vibe.
Exactly. The Stellantis CEO specifically stated that even side by side, they are tuned to look, feel, and act different.
The report compares it to the old Dodge Charger and Chrysler 300 strategy, right?
Yes, exactly.
They share the same underlying chassis, but the aggressive tuning of the Charger attracted a totally different demographic than the softer, chrome-heavy Chrysler.
That is the exact playbook. By engineering such sharp sensory and mechanical distinctions, they simplify the dealer's conversation. It protects the pricing power of both brands without them cannibalizing each other.
I understand the theory, but I have to push back hard on this. Can you really stop buyers from cross-shopping two massive, expensive three-row SUVs just by giving one a V8 and the other an inline-six when they are sitting 50 feet apart in the same building?
It's a fair point.
The physical proximity defeats the psychological separation.
Your skepticism is entirely justified, and to be honest, the strategic overview itself clarifies that this strategy is great in theory, but the specifics are incredibly murky.
Murky how?
Well, the grand theory falls apart when you look for hard details. First, the pricing for the Ram Charger hasn't been announced, so we have no idea how it structurally competes with the Wagoneer's price tag.
Right.
Second, the CEO hasn't confirmed the exact specifications of those supposed V8 engines for the Ram. And finally, the timeline for delivering that advanced EREV technology for the Wagoneer is inconsistently reported.
So a lot of it is still up in the air.
Stellantis is banking heavily on distinct identities, but the actual mechanical reality of those identities isn't fully locked down yet.
Okay, so let's pull all of these moving parts together. We've mapped the entire journey from the digital first impression to the physical metal on the showroom floor. When you look across all of this evidence, what are the grand themes driving this industry?
Well, I think three massive themes emerge across these sources. The first is tech accelerating the physical. The industry is obsessed with removing human bottlenecks from physical spaces. We see it in UVI's AI scanners, aiming for under-a-minute diagnoses, and we see it in Upstart's push for 10-second automated lending decisions.
Making the physical world move at the speed of software.
Exactly. The second theme is the evolution of trust. The mechanism for making a buyer feel safe has completely bifurcated.
How so?
Well, emotionally, buyers need that raw, unscripted social proof we saw in the Glow 3D video stories. But financially, they need the deep safety that Upstart provides by looking past a simple credit score to validate their actual economic reality.
Right. And the third?
The third theme is extreme agility. Dealerships and OEMs are actively rewriting the rules to protect margins, whether that's the Peter Cooper Group adopting new Chinese brands at lightning speed, or Stellantis artificially separating Jeep and Ram identities to protect pricing.
But those forces are definitely slamming into each other. I mean, look at the contradiction between tech and human truth. Upstart and UVI push for hyper-automated faceless efficiency. Remove the human, feed the algorithm.
Right.
Yet, Glow 3D argues that raw, unscripted human video is the only way to build real credibility. It's like the industry is torn between replacing the human and desperately needing the human.
There's also a massive tension between high-tech dreams and brick-and-mortar realities. Stellantis is pushing these advanced EREV luxury SUVs, yet on the ground, dealers like Peter Cooper are shutting down physical body shops because they literally can't afford the rent or the insurer rates.
Yeah.
The high-tech dreams are colliding with physical economic realities.
So boiling all of this down for the listener, what's the ultimate practical, so what's takeaway here?
I think the inescapable truth is that technology and clever marketing only amplify what's already there. As we saw with Upstart, tech cannot fix weak fundamentals. If your showroom process is broken, a 10-second loan approval or a 60-second AI scan will just get the customer to a broken experience faster.
A faster disaster is still a disaster.
Exactly.
That is a sobering reality check for an industry obsessed with software.
It is. And you know, it leaves me with one final thought for everyone to mull over. As cars become rolling computers and AI takes over financing and inspections, does the dealership of the future actually sell cars, or are they just selling trust in an algorithm?
Wow, that shifts the entire paradigm of what a dealership even is. For you listening, here's a practical next step. Just keep an eye on how your local dealers are changing their physical footprints. Notice that there are fewer traditional service bays and more of those AI drive-through scanners. The physical world is reorganizing itself right in front of us. Thank you for joining us for Auto News Talk. We'll catch you on the next one.